Quick overview. Paladin is a pure play ASX listed uranium company, and we're based in Perth, Western Australia. We've got our principal assets in Africa, in Malawi and Namibia, and we've got projects in Western Australia, Queensland and Labrador in Canada. 14 years of production history across those two mines, both on care and maintenance at the moment. And outside of the two mines, we've got 320 million pounds of resources, which makes us one of the biggest uranium companies in the world in terms of resources. Market cap about $200 million. Current debt in the form of bonds, about 130 million, 40 million US cash in the bank. One of the most opaque things in the market, in the uranium market, is global stocks. So current primary supply sits at about 135 million pounds. There's been about 45 million pounds come out of the market in the last 4 or 5 years or so as the market is corrected. Demand sits at about 195 million pounds. But one of the opaque numbers is stocks. But what we do know, no one really accurately reports their stocks. The uranium stocks are held in various stages of the fuel cycle around the world. About 50% is held by governments, about 35% is held by utilities, some of which is legislated in terms of the number of stocks they've got to hold, and the rest is basically held by traders and physical stocks. But what we do know, if you look at that middle graph in there, demand fulfillment, we know there's been about half a billion, 500 million pounds has come out of the market in the last 6 years, and that's pretty significant. So we know there is a significant correction coming, but month by month we really can't say when that's going to come. It's really dictated by utilities coming back into the market and buying, and particularly US utilities that have been out of the market for the last 18 months, while there was a Section 232 petition for a 25% quota that was lodged by US suppliers. That story is still unfolding and will take about another month or so to come out, but we do know 500 million's come out, so that's extremely positive. The resultant supply demand, that's what it looks like on the left, if you like. We basically forecast a low demand case and a high case. WNA just released their fuel report, which had 3 cases in there. Looks very similar in terms of low and high. The low case is really dictated by the fundamental assumption that as new utilities, new reactors are built, you will get closure of old reactors around the world. Now, what we're seeing unfolding right now, particularly in the US and Great Britain and in India in particular, we're seeing that the life of current reactors is being extended. So in the US, you've probably seen news of subsidies in various states, and the decision to actually extend the life of utilities that are built for normally about 40 years, they're being extended out to 60 and even 80 years. So India is doing the same. So we're seeing a shift away from that pessimistic case towards the growth case, somewhere in the middle. And it mightn't look much if you're looking at, say, 40 million pounds coming in terms of the growth case, but 40 million pounds is 20 times the average uranium mine, 20 times the average. It's about 8 times the production that we get out of Langer Heinrich, which I'll talk about in just a moment. One of the more significant mines in the world. The other significant feature in the market right now, if we look at that right-hand graph, is that in the US, the level of contract coverage for utilities is decreasing. If nothing changes, the US utilities will be at 20% contract coverage by 2025. Normally, a utility covers 90% of its future production under contract because of the necessity for energy security. So if you're in the US buying 50 million pounds a year and supplying 20% of the US's power, you normally have 90% contract coverage. So that's decreasing, and hence an increasing degree of urgency to come back into the market. Our principal asset is Langer Heinrich in Namibia. So we've just finished a PFS1, pre-feasibility study on a rapid restart. We've just put the announcement out last week. We set ourselves an aspirational target to come in at less than $30 a pound, and we've just achieved that, which makes us the lowest cost uranium mine in the world. And in the lowest half of the cost curve. We've got a plan to bring the base operation, as it pretty well went on to care and maintenance a year and a half ago, about 5.2 million pounds per annum capacity. We can bring that back into production for $80 million. But importantly, we've also recognised the opportunity to expand that operation to a 6.5 million capacity, which makes us about the 4th biggest producer in the world for a single operation. We also announced a maiden vanadium resource, the first time. We've always had vanadium in that ore body, but for 10 years it has never been a commodity that's been targeted for production. Vanadium's been a pretty exciting metal in recent times. About 9 months ago it peaked at $30 a pound. We've got a long-term forecast of about $8 a pound, and we think that we can produce it on an incremental cost basis for less than $3 a pound. We've also got parallel work going in a pre-feasibility study that will look at major upgrades to the process plant. And we believe that we can get another $4.50 in cost savings, which is really about reagent consumption, one of our bigger costs there. So the capital, $80 million restart for a 5.2 million pound operation. Roughly half of that is basically repair and maintenance, and the other is just working capital to restock what is, as you can see from the photo on the right-hand side, is a very large existing operation that's sitting there, and the usual things about first fill of reagents, recommissioning, mobilisation of a workforce and equipment, etc., and just the costs associated with bringing a large mine back into production. So importantly, we can expand this operation to 6.5 million pounds for an incremental cost of $30 million. That gives us a capital intensity of about $23 a pound, compared to $110 to $120 a pound to establish a new operation. It's low risk. We're not introducing any new technology here. This is just basic operations focused on debottlenecking the existing operation. And if we finish our studies in this care and maintenance period, we can be back in operation, subject to having our recovered uranium price, but having our contracts in place, we can be back in production mid to late 2021. It's there, it sits there right now, the plant, and that's our advantage. It makes us the first starter back into production in a recovered uranium market. We've announced the sale of Paladin Africa, which is our mine in Kayelekera. It's been on care and maintenance since 2014. It requires a higher incentive price to come back into production, around the same kind of costs as a new mine would, even though it's built there. For us, the decision is about cash preservation while we're on care and maintenance. Put about $40 million into care and maintenance since 2014 when it went on care and maintenance. So we've got a sale process underway at the moment to Hylea. One condition precedent to satisfy at the moment, that's government approvals. And when I return from New York back to Australia, I'll be turning around and heading to Africa. We expect to get that completed hopefully in the next month or so. So, in summary, why would you invest in Paladin? If you are interested in uranium, we sit in a very unique position by ourselves. So we've got a diversified portfolio, not only that production capacity that's sitting there waiting to come back into production. We've got 320 million pounds, one of the largest resource holders in the world. Outside of those, we've got the lowest lead time back into production with $80 million capital to bring a 5 million pound production back into the market, compared to $700 million if you were going to build that today. Lower incentive price, $30 a pound, so $45 a pound market would make us very, very happy. We've got 10 years of experience, so we've marketed to China, Taiwan, the US. We've still got those marketing contacts. We don't have to jump the hurdles, so that's there. Right now, we're focused on minimising our expenditure whilst we're in care and maintenance, and we've got initiatives underway to do that. We're funded now for the next 4 years, fully funded. And finally, just to put it in perspective, that one mine is 7 to 8 times the entire US production. Thank you very much for listening.